And then we'll maybe start in 2 or 3 minutes. Hi everyone, a very warm good evening to all of you and welcome from Mirae Asset. Today we'll be talking about our two new upcoming NFOs which we have started. The NFO is already live. Nifty 50 index funds and Nifty large mid cap 250 index funds. Without wasting time, I will quickly share my screen. Yes, my screen is visible, right, to all of you. So first, we are coming up with two index fund. Both are something which are very unique in terms of the market offerings. Something which is very staple. One is your Nifty 50 index fund. We believe this is your most core part of the portfolio that ideally should be included in, with some exposure in everyone's portfolio, those who are participating into the Indian equity market. Most of you are aware what Nifty 50 is. It is also considered largely a barometer, of course, along with Sensex 30, largely a barometer of Indian stock market, right? So we are coming up with Nifty 50 index fund. It's a passive product. It will be replicating, tracking Nifty 50 total return index. So largely what we are trying to do here. So I'm sure most of you are following the markets. So when you follow the market, you see how many points Nifty has moved up or Nifty has moved down. Or let's say whenever you are having a conversation with your friends, with your families, or let's say just professionally, and you're discussing, okay, where did the market move yesterday, or what was the percentage increase in the market, then you end up talking about either Sensex 30, Nifty 50, right? So that is your first reaction. If I ask you, okay, how much did the market move yesterday? Some of you would have told, okay, X percent, Y percent. And then if I ask what is those percentage, you will tell, okay, this is what Nifty 50 moved, right? So we are offering an opportunity in form of an index fund, which is your mutual fund route, to participate investor in that Nifty 50 index, which everyone keeps talking about, which everyone keeps referring about. So largely, the NFO starts from October 10th. It will close on October 18th. So as we have seen, right, passive market has grown specifically over last 4 or 5 years. COVID has a lot to do, with the rise in passive, of course, with the growth in the demat account. You look at total AUM somewhere around north of 2,85,000 crore in December 2020. In August 2024, that has increased to almost 11 lakh crore. And if you look at a good amount is attributed to the index fund, right? Almost 2.65 lakh crore. And what is all about, index funds? It's basically a mutual fund. So whenever you are investing, or most of you have bought a mutual fund similar to that, but instead of an active manager managing the fund, here you have index being replicated in form of a benchmark. It is managed without an active manager, which means there is no subjectivity, there is no biasness involved in selection of sector, in allocation of weight, etc. Your performance of the fund is directly linked to the performance of underlying index, which is Nifty 50. So let's say in 5 year, potentially Nifty 50 gives a return of 10%. Your index fund will give you return somewhere around 9.5%. That 0.5% can be attributable to cost, leakage, etc. More importantly, it's a very low cost medium for most of you to participate. Let's say if somebody at your end, if somebody was replicating Nifty 50, because most of you know what are the constituents forming part of Nifty 50. So if you are trying to replicate that index at your end, you will have to churn your portfolio, which means you will have to buy and sell, frequent buying and selling. That will trigger your short-term capital gain, which will make you liable to pay capital gains at the rate of marginal tax. What you're looking at here at short-term capital gain for a equity instrument. So from that perspective, an index fund is a better option. And then largely broad market exposure, right? When you invest in Nifty 50, almost you get exposure to 60, roughly more than 55% of the entire market cap listed on National Stock Exchange. Now, what is Nifty 50 index? How it is derived? Largely, all top 100 large cap names on which FNO is eligible are qualified or eligible to be qualified to be part of Nifty 50 index. Top 50 stocks based on last 6 month average free float are selected. Most importantly, this is not a static portfolio, which means 10-year back, what are 50 names forming part of Nifty 50 index? You won't find all names being right now as well. Of course, some stocks would have continue to have retained their value in Nifty 50, but every 6 months you will hear, some stocks moving out, some stocks coming in Nifty 50 index. Now, which means every 6 months, that is March and September, stocks come in and move out in Nifty 50 index. However, subject to a cap of in one calendar year, maximum five number of stocks can come in and move out in Nifty 50 index. Now, which means in any year when you're investing in Nifty 50, roughly your 45 names will be same, right? Which means it provides a lot of stability to the portfolio. You're looking at largest of the large, most blue chip, decorated, coveted names forming part of the index. Now, why you want to participate, in Nifty 50? Of course, people will talk about shrinking alpha, your active funds are lagging in terms of performance. But at core, what you can also understand and look at is that if somebody wanted to, start their journey of equity investments, if somebody wanted to understand, gauge the depth of equity market, specifically the volatility of the equity market. They have never experienced before what it is like to participate in equity market, and they want to take it very slowly, gradually, want to adjust themselves to the market's volatility, to behavior of the market, to fluctuations of the market. Then I think Nifty 50 is one of the most suitable product for you, because what happens is it allows you to settle over your investment journey. It allows you to get exposed to what kind of an equity behavior can be without overexposing your risk, right? Without going over and above the risk that we are talking about. Of course, you can compare it with large cap active funds and everything, but at heart, what we believe is this is something a core product that needs to form part of each and every investor portfolio, especially if you're entering the equity market for you're not a seasoned, you're not a veteran, you have heard about equity market, you have heard about wealth getting compounded, getting made in the equity market, then Nifty 50 is probably one of the potential instruments, whether on the active or the passive. You can look at when you compare it against all the stack of mutual funds. There are so many offerings right now. You have n number of funds coming from sector, broad base, international, thematic, but Nifty 50 continues to be your core part of the product that helps you to balance out and most importantly adapt yourself to the equity market behavior. Now, if you look the kind of exposure you get, it is very similar to an active fund. Active fund on and large are 22% towards banks, Nifty 50 is 27% bank. Then of course you have IT software, your big IT giants name like Wipro, Infosys, TCS forming part of Nifty 50, 14%, 9% in an active fund. So largely you have a decent allocation happening across all sectors, and that's why it is also called a sector neutral or sector agnostic portfolio, which means when you're investing in Nifty 50, you're investing at that point in time some of the best sectors represented in the market, and as time evolves, the sectors get evolved, and this is what you see, right? For instance, if you look in 1995, there was no IT company listed, or even if it is listed, it was not forming part of Nifty 50, right? Similarly, there was no consumer durable companies. The representation of pharma was just 2.7%. Again, but now if you see your financial services on the backbone of how important they are, the weightage of financial services has increased from 20% in 1995 to 33% currently. Your IT has almost 15% weight. Your oil and gas has moved around, went as high as 25% in 2005. But right now it is at 12%. Your automobile has, which had a weight of almost 12% in 1995, today is a weight of 8.3%. So largely, whatever is the changing dynamic of the Indian equity market that gets reflected in Nifty 50 at over, longer investment horizons when you're looking. And even if you look at some of the names, right? So this what we are looking here, that what has been the latest inclusion and exclusion. And as I was saying, in any one calendar year, you won't find inclusion exclusion more than five names. And that's what you see, right? In, for example, in 2005 to sorry, in 2017, in March and September combined, you have a total five inclusion exclusion happening, right? Your Bajaj, HPCL, UPCL, India Bull, and Indian Oil Corporation made their way into the portfolio, and your ACC, Bank of Baroda, Tata Motors, BEL, Idea Cellular moved out of the portfolio. In any year, maximum five stocks, which means you have a very stable portfolio. When you are investing into, some names still continue to be part of the index since their inception, right? So since Nifty 50 was floated, your Reliance Industry, HDFC, L&T, ICICI Bank, Bharti Airtel, Axis Bank, Infi, TCS, ITC, SBI, they still continue to form part of the index. Now, as I said, it's a very sector agnostic portfolio, which is sector neutral portfolio, in terms of at that point in time, what is flavor in the market that gets reflected: financial services, IT, oil and gas, FMCG, automobile, healthcare. Your top 10 names are, of course, HDFC Bank, Reliance Industry have a combined allocation of almost 21%, followed by ICICI Bank, Infosys, combined allocation of roughly 13%, your L&T, ITC with a combined allocation of almost 8%, and of course, followed by TCS, Bharti Airtel, State Bank, and Axis Bank with a cumulative weight of the residual amount. Now, in terms of performance, largely when you hear a conversation about equity markets, right? When you, let's say, you're just typing in on your laptop, on your iPads, on your phone that, okay, this is what I have to assume in terms of a return investments. And most of this site, they give you average of Nifty 50, and generally they can tell you 12% over 10 year or something like that. But largely that data of 10 or 12% is taken as a on the backdrop of performance of Nifty 50. So if you look at in terms of performance, specifically on a rolling basis, then Nifty 50 has delivered again to that mandate, what we are talking about over 3 year, 5 year, 7 year, 10 year, around 12% CAGR consistently. So if you look at for investment horizon of 3 years, it has generated rolling return of almost 12.5% and 14.8% in 5 year average period. It is a great tool. Again, as I said, if somebody wants to adapt and get used to the Indian equity market, allow them to settle how equity markets, how you behave in Indian equity markets, right? Because frankly, there are a lot of new investors coming into the market, but you don't understand, let's say, the a lot of technical things, like, you have small cap, mid cap, how much to expose yourself, because for all those you need that slight understanding. But Nifty 50 is something that you can, with minimal effort, you can understand what this product is that you're investing in. Top 50 blue chip names, which is not sector or not stock specific concentrated. So as a result of which you can do your lump sum, which we saw in the previous slide, but also you can participate in a systematic manner in this index via this index fund. So if you look at the comparison, and that's what you see, right? For on a 10-year basis, if you do a lump sum investment, you make 13.6%. If you do SIP investment, you make roughly around 17% CAGR. Of course, this is based on the index performance historical data, not the actual fund performance, but this gives you a rough idea of where ballpark estimates can be when you are trying to anticipate the performance. Again, if you look at calendar year, largely very few calendar years it has done bad, because if Nifty 50 does bad, that means an indication that the Indian stock market is not doing well largely, and that's what we have witnessed. So if you look at since inception, more than 15 years, the wealth compounded is in excess of 13, 14% on a CAGR basis. Again, on a calendar year basis, 2015 was a bad year, so it's almost a negative 3.01%. Rest of the years, you would have seen some good performances happening across. Now, in terms of evaluation, so this is as of September 5, you look where it is. The index is trading at a multiple of 23, Rafish, compared to its 5-year average of 21.5. So that's a slight premium of 6%, but discounting, data challenges and as well as, association with data mining and everything, we can say largely it is, I'll not say extremely overvalued or extremely undervalued, but somewhere between that zone of being fairly valued to slightly overvalued. But now, if you look at because of the correction that has happened, then of course it is comfortably in that zone of between being fairly valued and slightly undervalued at what you can look at in terms of performance. So why Nifty 50, right? So as I said earlier, it's a barometer of Indian stock exchange, which is when you're investing in Nifty 50, you are essentially capturing more than 65% of free float market cap of all the stocks listed on National Stock Exchange. Index fund is one of the low cost option to invest. You're investing in 50 blue chip names spreading across 13 different names. And as I said, what it does more importantly, it has that element of stability, adding element of stability in your equity portfolio if you're investing for a longer investment horizon. Specifically for those investors who don't understand equity market or who are very new to equity market, then this can be a core product to allow themselves to get introduced, to get used to the market volatility, to adjust and adapt the behavior of up and downs of market. And of course, all those investors, seasoned investors who are already there, they will understand the importance of Nifty 50 and some allocation of their portfolio they will always have towards a Nifty 50 index, because this is largely the most widely tracked benchmark. Always remember that the conversation you are hearing about equity market in terms of return, in terms of what is the performance, in terms of SIP calculator that you see on online, all data are largely based on performance of Nifty 50 over last 5 to 10 years. So this is one index fund which we have rolled out. Of course, the NFO has already started from today. It will close on October 18th. We'll allot at a 10 rupees snap on 24th October. This is a passive scheme which will be managed by Ka and me. Minimum investment amount during NFO is rupees 5,000 and multiple of rupees 1 thereafter. Then there is nil exit load when you are participating in the fund. So this is about Nifty 50 index fund. We are also parallelly, we have started another NFO, which is large mid cap 250. I'll cover this and then I'll take the Q&As associated. Now, large mid cap 250 index fund. Now we talked about Nifty 50. So what Nifty 50, as I said, it is for somebody who is getting introduced to the equity market, a very good product for somebody who wants to taste, or let's say who wants to get themselves adapted to the behavior of equity market. Again, index that has been for more than 2 decades, 2.5 decades in existence. So the performance something that can be tracked widely. But let's say for somebody who's a seasoned investor who understands equity market, who's ready to give that sufficiently long investment horizon of 5 year plus that we are talking about, then you can also look at large mid cap 250 index fund. What happens here is you're investing in a large cap Nifty 100, you're investing in Nifty mid cap 150, you're combining both 250 set of stocks and you give a 50% weightage to large cap, 50% weightage to mid cap, and then you make a large mid cap 250 index. Now, why do you participate? I think it's important to reiterate that India now retains among top 5 largest economy of the world, specifically for next 2-3 decades. World is talking about that relative to other markets, Indian equity market potentially has the best potential compared to relative to the other markets. You see the growth story already talking about market cap GDP ratio, NSE's derivative being market being the largest, of course. Now, if you look at in terms of size also, market has grown. For example, in 2000, if you look at the large cap, 5 years back, a large cap was 28,500 crore, would roughly give you a large cap tag, but right now that large cap tag is almost 90,000 crore. Similarly, mid cap, 8,200 crore rupees tag was a mid cap, but now you need 27,600 crore to be mid cap tag, right? Small cap, even 1,000 crore company was small cap, but now you need that cutoff of 5,000 crore. So a large number of companies have, migrated in terms of they have grown large, has become larger, your mid caps have grown. So similarly, a lot of these companies are increasing. Now, as we discussed, right? This is a fund which we will invest in large cap, which will invest in mid cap. Now, what happens because of each component? Now, because of 50% exposure to large caps, your large cap companies are predominantly something that they intend to provide stability to your portfolio. Of course, there is an element of risk, but that element of risk, it is relatively less compared to investing in a mid cap or a small cap. So that's why with exposure to large cap, with 50% exposure to large cap, you can get a portfolio stability. They are relatively less volatile, large cap stocks compared to mid and small cap stocks. Of course, some individual names may be more volatile, but largely they are less volatile. And because they are less volatile, what happens is they protect your portfolio specifically at the time of market distress, when there is stress in the markets, market crisis, correction. And that's what you would have seen, right? Let's talk about 2013, 18, 2019, 2022, whenever your small caps, mid caps have fallen less, your large cap has stayed resilient, right? 2013, your mid caps corrected by 1.3%, small cap corrected by almost 6.4%. 2018, your barrier for mid and small mid category, your mid cap corrected by 12.6, your small cap corrected by 26.2, your large cap, in fact, ended up giving a positive 2.6. This is what you're looking at, right? And even if you look at volatility, last 10-year volatility for large cap is 16. For mid cap, it is almost 100 basis point higher. For a small cap, it's almost a 300 basis point higher. So relative to mid cap, small cap, your large cap allocation intends to provide that stability angle to your portfolio, which is 50% in this fund. And then you have 50% allocation to mid caps. Mid caps are generally known as your wealth compounder, consistent wealth compounders across the market. You have a good average ruling return, as you can see, for the mid caps, 3-year, 5-year, 10-year ruling return of almost 15.9%, 3.5% extra to large cap, 3 2% extra to small cap. Now, some of you may ask that if your mid caps have given such a good return, then why invest in large cap, right? But see, you'll also have to understand that your mid caps and small cap always perform in lump, which means they perform for really good period of a time cumulatively when they do well, but they also underperform in a lump, which is together whenever they are doing bad. So let's say, like for instance, between 2008 to 2016, 17, small cap index, 250 small cap index was essentially flat, which means for an 8-year period, if you had invested 100 rupees in a small cap, it would have given you 100 rupees back. That's it. Nothing more, nothing less. So if you adjust for inflation, in fact, it would have been lower, right? But then subsequently from 2017 to 2024, if you see, small cap has recovered significantly. So that's what we are talking about when you're talking about performance in lump, which means it comes in bond, which means it performs very well for a good certain period of a time, then it underperforms also for a good certain period of a time. So whenever you're trying to combine anything, always you do not view just return in isolation. Just look at the riskiness of that part, and that's where your large cap tries to potentially minimize or minimize that risk specifically, or hedge that risk of lumpiness in the performance that can happen to your portfolio because of pure 100% allocation to mid cap or small cap. Again, why mid caps have been consistently wealth compounded is because a lot of your mid caps have migrated to large caps. So your Bajaj, Trend, Bharat Electronics, Hindustan, Unilever, a lot of your Bajaj Finserv, Tata Consumer Product, PFC, Varun Beverage, etc. Right? So if you classify, what happens is your large cap companies are your mature business model, which are providing you that growth with stability. Your mid cap companies are something which has a growth potential with moderate risk, and of course you have a small cap companies. On return to risk framework, large cap has a lower risk. That's why the return potential is slightly less. Mid caps you take slightly higher risk. That's why return potential is slightly less. For a small cap, your risk increases significantly. That's why your return potential increases significantly. But again, as I said, when you invest in mid caps, small caps, you have to acknowledge that there will be cyclicity, there will be lumpiness in the performance. That is, they will perform for a good period of a time, and then they'll also underperform for a good period of a time. And how do you hedge that risk? You hedge that by investing in a large cap. So when you invest in a large cap, it provides you stability in your portfolio. It provides you exposure to business leader, how when they grow, you do well, and it helps in managing the volatility during the market stress relative to mid cap, small cap. Similarly, what mid caps company do, the exposure 50% to mid cap, you get the high growth companies exposure potential to outperform large cap relatively, but it has a higher volatility. So how the index is constructed? Very simple. It combines and add up a Nifty 100, Nifty mid cap 150 stock, aggregate weight of both is set at 50% large cap, 50% mid cap every quarter. And within large cap, within mid cap, that 50% weight is based on free float market cap, which means ultimately your, let's say, Reliance weight and HDFC's weight will be based within the large cap segment to the extent of 50%. Index, again, it's not a static portfolio, it's a dynamic portfolio, which means just like your active funds, active fund manager take a call of buying and selling, moving in and out. The index also does that, but index does that in a predefined manner, which is every 6 months in March and September, index will decide number of stocks coming in, number of stocks going out from the portfolio, and every quarterly it will decide number of stocks uh, forming part of the index. Now you look at the weight, right? We talked about Nifty 50, where your HDFC and Reliance cumulatively had a weight of 22%. Here in large mid cap, because you are increasing the weight of mid cap sections, your weight of HDFC and Reliance trims down to almost roughly around 7 to 8%. Your Infi, ICICI Bank, ITC, etc., DCS again just are left with 1-2%, right? So it's not a very concentrated portfolio towards one single stock. So it's not largely dependent upon one single stock performance, and you have a diversification spanning across both. Now look at this, what we are talking about, right? This is what I was referring to. Now, if you view in isolation, then mid cap value from 5,000 base has increased to almost 20,000, 27,000. But your large cap from 5,000 has increased to only 16,000. But when you invest in both, that lumpiness reduces, that volatility reduces, right? Large mid cap 250, and you're still able to take that return index for a potential of 5,000 to almost 21,000 as we see here. So this is combining best of both worlds, which is large cap that aims to offer your portfolio stability, and mid cap which aims to offer your potential for growth. And this is how it looks like. These are the top names of Nifty 100. These are some top names of mid cap already forming part of your top 20 stock list. Whether you're talking about in mid cap, Suzlon, Max Healthcare, Indian Hotel Persistent System, Lupin, or you're talking about top 100 names such as HDFC, Reliance, ICICI, Infosys, ITC, all get covered with an appropriate weightage. Most importantly, again, re-emphasizing that when you invest in Nifty 50, large mid cap 250, you have that opportunity to take a sector neutral portfolio or sector agnostic portfolio, because you'll have a representation of companies coming from each sector of each segment of the market. Now look at some of the names, right? Especially the bottoms: textile, media, entertainment, diversified. Of course, the weightage are small, but they have a representation only in the mid cap segment. When you combine both of them, you get some representation of such stock, even if your portfolio. Just look at financial services. If you're investing only in a large cap, your 30% portfolio is financial services, but relatively the weight of financial services in mid cap 150 is just 18%. So when you combine, you bring down the weight of effectively financial services to 24.5%, right? So this is how it happens. Compared to large cap, your weight of capital good, which is only 2% in large cap. You don't have a lot of capital good companies in large cap, but you have 15-16% capital good companies in the mid cap. That weight has increased to almost 8.8%, similarly to healthcare as well. So these are some of the benefits that you get by combining names from large cap as well as mid cap. Now, if you look at calendar year performances, then it has actually done reasonably well compared to Nifty 100, compared to Nifty 50. Yeah, but again, this product is more suitable when you're coming with the investment horizon of 5 year plus. On rolling basis as well, the index on 3 year, 5 year has done relatively better to Nifty 50, Nifty 100, which is your Nifty 200, which is large cap biased index. Periodic return, if you look at 15-year basis, large mid cap 250 has generated a return of almost 16.1%. Of course, this is the index return, not of return of the fund, but this gives you a rough good estimate, right? Now you look at compared to Nifty 50, that's almost a 3% extra return. But that 3% extra return is over the period of 15 years. So this is very important, that when you are investing something, when you have exposure to mid cap and you have exposure to large small cap, always have an investment horizon of 5 year plus. That's how you should view this product. And just look at the volatility, right? When you invest in standalone, let's say in mid cap 150, you have volatility of 17% 15 year, but in large mid cap combining, the volatility rate is 16.4%. In fact, very similar or slightly less than even Nifty 100. So this is the power that you can unlock when you invest in large mid cap 250. With this large cap, your portfolio stability relatively comes down or remains at par with Nifty 100, which is your large cap. And your mid cap, 50% exposure to mid cap has that potential for the growth element. Of course, you have large mid-cap actively managed funds. And if you look at regular plan, direct plan, almost 50-60% of actively managed large mid-cap funds have not been able to beat the benchmark, which also tells you that if you understand the market, specifically in the large mid-cap segment, if you want to allocate, then this is one of the products that can be forming part of your core portfolio. Quickly summarizing, because you will be investing in large cap, because you will be mid cap, essentially you will be investing in almost 90% of entire market cap companies listed on NSE. You are participating in both large cap and mid cap, where large cap aims to offer portfolio stability with some growth, whereas your mid cap, which offers potential for a lot of growth with some portfolio stability. When you combine both of them, we already saw your combined volatility has a potential to be less than your potential investing individually in a mid cap or equivalent to Nifty 100 index, and your performance slightly improves. And we have seen, right, compared to Nifty 100, Nifty 50, almost a 300 basis point of extra return over 15 years. This is very important, that you have to look at this period over the investment horizon of 5+ years when you are investing, whereas Nifty 50 you can look up to even 3 to 5 years. Again, the cost is very low. Now, why it is a tax efficient ways? Of course, this is an index you can replicate at your end, but for that you'll have to participate. You have to buy 250 stocks, regularly track the index, buy and sell the portfolio. As you sell, you will trigger some capital gain. You will have a capital losses, but let's take an example for simplicity that you're incurring just gain. You'll have to pay short-term capital gain taxes per the equity taxation, and that will make it less tax efficient compared to just investing in this index fund and participating in the segment. The NFO is already live. It will close on October 18th. The allotment will happen on October 24th. The fund will be managed by ICTA and main. The benchmark is large mid cap 250. There is nil exit float. Minimum investment during NFO is of 5,000 rupees. So yeah, that's it. To quickly summarizing that we are coming out with both of this fund, which is Nifty Mirae Nifty 50 Index Fund and Mirae Asset Nifty Large Mid Cap 250 Index Fund. The purpose of Nifty 50 Index Fund is to give opportunity for the investor to participate in the most widely tracked benchmark, something which is very known to all of us. Whenever we are having a conversation about equity market, we are indirectly referring to Nifty 50. Uh, just get used to the equity market volatility for new investors, and for existing investors, some allocation to help you protect the downside, specifically if you're aggressively invested on mid cap, small cap. And then, of course, the next one is Mirae Asset Nifty Large Mid Cap 250 Index Fund. There we are coming up specifically for those investors who understand the benefit of combining mid cap with the large caps, where your large caps offer you portfolio stability and mid caps offer you growth. But again, that has to be viewed with the investment horizon of 5 year plus. So yeah, that's it from our side. So if there are any questions, I think there are some questions in the chat box. I quickly take them. So if you guys, anyone has any question, please feel free to drop in the chat box. We'll take it up and we'll address. Yeah, so I think there's a question which is, how is this index fund different from those offered by other AMCs in the same categories? So largely, see, index funds are very similar because they are under tracking same indices. But how do you manage the index? That's a call which every AMC takes, as a result of which your tracking error and tracking difference will be different, right? You'll see that some indexes managed by some AMC has a very high tracking error. Similarly, if you look at our ETF track record, which we already have in the market, we are very close to the index. So we hope to replicate the same even on the index fund side. So there's a question which talks about how do you see your large mid cap active fund? Do you suggest better to move to index fund as you could not meet the index fund rate? So see, we also have a large mid cap active fund. See, the when you are investing in an active fund, you'll have to consider that you are going with analysis of fund manager. So you'll have to buy in the fund manager, and there you'll have to give a good sufficient time horizon. But again, if you want to hedge your risk of underperformance, what you can do is, if you're an active investor, you can invest two-third in large mid-cap active category and one-third in index fund. And if you're a passive investor, you can invest two-third in large mid-cap passive fund and one-third in an active. So you have a representation of both segment combined in your portfolio. So when one segment doesn't work, the other will help you to catch up, vice versa, depending upon what line of your market. Are distilleries included in these schemes? So depending upon, if uh, those companies, there are some listed names which are forming upon top 100, top large mid to 50, they will automatically form part of the portfolio. See, expense ratio will be very competitive. Nifty 50 will be on the lower side on the direct plan, and as well as that it will be on the lower side even for the large mid cap. But final expense ratio will be decided once the NFO is closed. Yeah, Ajay, I think you have a valid point. See, equity allocator is a large cap with some mid cap. That's a valid point. But if you look at where it sits largely with a 50%, almost 70 to 75% Nifty 50. And rest 10-15% goes to mid cap and next 50. Whereas large mid cap 250, what it does is only 50% to large cap and 50% dedicated to mid cap. So an equity allocator will never go as high as 50% to mid cap. See, the aim of equity allocator is to outperform Nifty 200 with an alpha of 1 to 2%. So we'll always be Nifty 50 heavy, which is 70, 75, 65 to 75% range. If I have to say so, your mid caps will go as high as 20, but not more than 20-25%. Whereas your large mid cap 250, your mid caps have potential to go 50%. So let's say if you want to be very aggressive in large mid cap allocation, you can look at large mid cap 250. But you want a large cap biasness with only some flavor of mid cap, then you can look at equity allocator. Yeah, so how this index fund outperformed over longish 5 years? See, 5 year, 5 to 7 years, we think the index has a potential to, generate a decent return in line with whatever is the market earning growth that you anticipate. So largely over next, if you're holding it for 5 to 7 years period, then it will be a good, then it will be a good uh, uh, I mean, a good well generator for most investors, ideally in an ideal scenarios. So expense ratio I've already talked. The presentations are already noted, and they are on our website. Girish has a question that you have in the market. You have Nifty top 10 equal weight index, 500 momentum index. How they all are different with each other, and why sudden craze for Nifty funds by all AMCs. So see, Girish, you have to understand that in passive you can create a product whenever you have an idea, right? Now, before investing in any passive or any active, the important part is doing due diligence. You at your personal level, when you are investing directly or you are in consultation with your investment advisor or a distributor, always try to understand the methodology of a passive, how it is doing, what it is behaving, rather than just looking at periodic return, 5 year, 10 year, 15 year return, but just understand the methodology and then see whether you are comfortable with that, right? For example, some smart beta will have a very high allocation to small cap, which you may not be comfortable with, right? Some small cap, some smart beta will run on certain factors in mid cap, small cap, which you may not be comfortable with. So always try to understand, uh, uh, the methodology of whether you're investing in active, like we talked about, right? When you're investing in active, of course, you can go on the recommendation of your advisor or distributor, but you'll also appreciate that you will like though that fund where you understand the process and the methodology. So similar to that, Yes, there are a lot of options in the market, but it's very important to evaluate whether it fits very well for you. So having a lot of options in the market, what it does is, of course, on the upper, it looks like it confuses you, but if you ask, uh, it actually answers you uh, pretty well. For every different investors, there will be different funds suitable depending upon their goal based investing, depending upon their retirement mandate, depending upon how they want to time it, etc. So this can be used accordingly, tactically, strategically. So what we'll urge is, always understand the methodology in any active or passive. In active, understand the framework. In passive, understand the methodology, and then see whether your portfolio, your risk tolerance, your willingness and ability to take risk gets aligned or not, and then you can participate and choose not to participate. Uh, how is this index fund different from, say, an equity? See, equity saving fund is largely your uh, lower risk. This is pure equity fund where you're not, mixing any kind of a feature and etc. So that's a very different category when you're talking about. We do you have any beta funds that we should evaluate? See, Ravi, we post uh, three smart beta fund of fund options: alpha fund of fund, mid small cap 400 momentum quality, and momentum small cap momentum quality 100 fund of fund. But as I said, you'll have to understand first the ideology. Everything is available on the website. You can reach out to our social media in case of any specific query. So what time can we target in this fund? See, Nifty 50, you can look at for 3 to 5 year. Of course, anything more than 3 year, that's minimum. But 3 to 5 year is a generally good period for Nifty 50. Large mid cap 250, I would urge you to consider for 5 plus investment horizon. Again, see, Mirae Large and Active has delivered a good return, as you rightly said, 20%, right? Whereas the index is at 15%. Now, the call that needs to be taken by you is whether you believe that Mirae Active will continue to give you that additional 20% consistently. Now, what you can do is you can completely trust it. You have, you understand the framework, you understand the active, how it works, and you can completely keep your 100% allocation to this. But let's say you want to hedge your downside, you feel no, maybe it's not possible, or maybe there will be some years it will move up and down and that ratio will decline. Maybe it has a potential to go below 15. So in that case, what you can do is just a hedge. See, everything is hedge relatively. You're talking about, you can still be biased towards an active mere large mid cap, give 67 rupees to actively manage large mid cap and give 33 rupees to passively manage large mid cap. So in that sense, even if you're underperforming on the active side, it gets covered here on the passive side. For somebody, let's say, who's an passive pro, he believes in the passive investment because of the clear methodology, detailed and everything. What he can do is, I would also urge him to invest, let's say, 67 in large mid cap index fund, but invest 33 in the actively managed large mid cap fund. So you'll have to weigh in both, where you fall literally on the spectrum, and then you can make a allocation. It cannot be just a black and white comparison about return that this is 20%, this is 15%, this is how I'll go, whether it is a lot of passive funds or etc. Yeah, so I think that's a good question, whether you recommend a lump sum or SIP. So, say large mid cap 250, you can look at, if you're investing for a 5 year plus investment horizon, 5 to 7 year, then lump sum also makes sense. But we'll recommend doing SIP. Nifty 50 also, you can participate in a lump sum if you're keeping it for 3 to 5 year. In large mid cap, we'll prefer to do SIP staggering. In Nifty 50 also, over 10 years, SIP has outperformed lump sum by 4%, right? So SIP always has that edge of, averaging out, dollar cost averaging out, which helps you. But again, in Nifty 50, you can participate in lump sum, even in large mid cap. Lump sum, when you're investing, give it 5 to 7 year. In SIP, of course, even 3 to 5, 5 to 7 year makes a lot more sense. So yeah, that's it. I think we have answered all the questions, but still, in case you have any queries, please do reach out to us on our social media handles. We'll try to revert as much as possible. So thank you and have a good day.